Electronic design automation. How can NVIDIA design its AI chips without sinking billions into physical prototypes that may or may not bear fruit? Well, like everything in today's world, there is software for that. But this is highly specialized and advanced software that serves as the cornerstone of the semiconductor industry. And one of the top EDA firms in the world just released their earnings. Yes, Cadence Design Systems is an essential player in the chip ecosystem, and their software is pivotal in creating the world we live in today. Welcome to the Quality Investor. I have already discussed ASML's and Lam Research's earnings, both being crucial equipment providers for chip fabrication. Today, we continue our deep dive into the semiconductor ecosystem via earnings reports of the major players by looking at the quarter Cadence Design Systems just had. My initial takeaway from Cadence earnings was that it was pretty good. It had growth, but it is decelerating growth, and they did raise their full-year revenue guidance slightly for 2025. Nonetheless, it was still a solid quarter, the details of which we'll get into shortly, and the market reacted in a shoulder shrug way as the stock only had a slight drop of less than 1% so far in pre-market trading. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Cadence provides essential software tools that allow chip makers to conceptualize, simulate, verify, and manufacture complex chips without building physical prototypes. Virtually every major chip produced today relies on some Cadence solution, making it indispensable for reducing time to market and minimizing costly errors. This is a very good position to be in for a business. Cadence also offers semiconductor IP, which is reusable, ready-made tested components you plug into your chip design. But this is a small part of their business at about 14% of revenue. Their EDA segment is their core segment with about 71% of revenue. While businesses such as NVIDIA, AMD, and Qualcomm are considered a part of the fabless design part of the ecosystem, Cadence and its duopoly partner Synopsys provide the tools to the designers so they can design. This makes Cadence foundational to the chip ecosystem, and because of that, Cadence has developed a wide and deep economic moat. A key part of Cadence's value proposition is AI integration into their own products to enable the AI of the hyperscalers. Cadence is at the forefront of the AI supercycle, integrating machine learning into its tools to automate design iterations and enable billion gate power analysis for NVIDIA GPUs. These innovations address chip design's increasingly extreme complexity while optimizing for energy efficiency in AI training and edge computing. As AI chips evolve toward 3D stacking and quantum integration, Cadence's tools are critical for the emerging 300 billion AI chip market. Cadence and Synopsys each have roughly 30% market share in EDA software. And while it operates as a duopoly, it still has the aforementioned wide economic moat due to high switching costs. Once a company integrates Cadence's tools, migrating is prohibitively expensive and time intensive. Cadence serves 98% of the world's top 50 semiconductor companies, including NVIDIA, TSMC, AMD, and Intel, and they are powering breakthroughs in AI accelerators, 5G, autonomous vehicles, and high-performance computing. Cadence has a solid 2025 in the market so far with 16.9% return year-to-date right before its earnings release. On a 10-year basis, however, it has seen a strong 32.1% CAGR in the market, so Cadence is squarely a compounding machine. And since Cadence provides software, it is also ultra-high margin, making it very attractive to investors. Pre-earnings, Cadence was trading at $351, just off its 52-week high of $376.45. So we'll need to assess if this is too high or if there is still value to be had at this price. They beat on their top and bottom lines, and while they did raise their revenue guidance, it is important to note that they lowered both their GAAP earnings per share and operating margin guidance. This has contributed to the small post-earnings sell-off. Another interesting thing about their earnings was China. China accounted for 18% of total revenue, double the percentage from last quarter and up 50% from 2024. This comes amid the trade tensions between the US and China, and even after the DOJ fined Cadence in July 2025 for export violations. The increase was primarily attributed to broad-based momentum across Cadence's product portfolio, particularly in the semiconductor intellectual property and emulation verification hardware, which was driven by surging demand for AI and high-performance computing designs in China. Chinese customers ramped up investments in advanced chip design tools to support AI accelerators and data center expansions. I mentioned semiconductor IP, reusable components of chip design, and Cadence completed an acquisition this quarter of ARM Artisan Foundation IP, a semiconductor IP division of ARM Holdings. This will boost Cadence's own IP segment, but they do not believe it will materially add revenue until 2026. The deal itself is small, however, at about $150 million according to one source. So we'll see how accretive this deal becomes. As with any acquisition, the worry is that it adds a business that isn't related to their core offering. However, this appears not to be the case here. Cadence has been an elite performer in the market and is poised for even further growth as AI chips drive even more complexity in chip design. So, let's dive into these earnings and assess at what price Cadence would be a prudent addition to a high-quality portfolio. So Cadence Design was pretty flat right after earnings, but they did open down over 4% today, but has since bounced back a little bit. You can see that they're now up a little bit more, and they're now just under 3% down. We'll see what happens throughout the rest of the day, but they are getting a little bit of a hit due to their mixed earnings report. I mentioned that Cadence was a compounding machine, and you can certainly see that reflected here. They have nice growth here on their revenue, consistent 10+% revenue growth per year. Their gross profit has been growing nicely. And while they had a bit of a dip between 2023 and 2024 in their free cash flow, they're back on track on a trailing 12 basis. Although their operating cash this quarter did slow a bit, which was also concerning to the market. But if you look at Cadence, because they're software, they're very capital light, which just adds another reason for this business to be so attractive to investors. Cadence came in at $1.3 billion in revenue this quarter, which is a solid 10.2% gain year over year. However, that is a decelerating growth rate quarter over quarter, as in both Q1 and Q2 of 2025, we did see over 20% year over year growth rates. Something else that's slightly concerning is we look at this number here, $118.7 million for the cost of product and maintenance and $63.5 million for the cost of services. This is basically their cost of goods sold. In the prior year, that resulted in a gross margin of about 86.6%, but that has shrunk a little bit to 86.4% this year. And on the year-to-date basis, they're down from 87% gross margin to about 86.2% gross margin. So we are seeing a bit of margin contraction here, and their operating margin is not helped by the fact that they had this loss related to the contingent liability. This is the DOJ fine I mentioned earlier at about $128.5 million. So because of this, we're seeing that lowered guidance for their operating margin on the whole. In this quarter, they did rebound on their earnings per share. We can see it came in at $1.05, which resulted in 20.7% year-over-year growth from last year's at 87 cents per share. However, on a trailing 12 basis, they've only grown their earnings by about 1.8%. And again, a big part of that is due to this DOJ fine. Another concern the market had in this quarter was that their cash flows are slowing down a little bit this year. So they have $1.175 billion in cash provided by operating activities. And while that's solid growth over last year's of $819 million, we've seen their free cash flow shrink in every single quarter so far in 2025. Now, the market was a little bit concerned about that, but if we notice, it's mostly because they're beefing up their working capital needs, which in my view is not a big deal. Their depreciation, stock-based comp, and kind of above the working capital lines here are all pretty much in line with last quarter. And they did have $100.8 million in PP&E outlays. So they do have over $1 billion in free cash flow so far in 2025. Another positive on this earnings report, however, that's not getting a lot of attention is the quarter end backlog was at $7 billion, which was about a 10% increase quarter over quarter from last quarter. And they have remaining performance obligations, or RPO, of about $3.5 billion, which was a 13% increase quarter over quarter from Q2. So these are two very important metrics for software companies. So Cadence is showing their strength here and the continued strong demand for AI as their backlog and RPO continue to increase at a nice pace. We do see that their top end of their revenue guidance is at $5.292 billion for fiscal year 2025, slightly higher than the $5.27 billion that they forecasted last quarter. But they did have that margin contraction, 27.9 to 28.9%, down from 28.5 to 29.5% from last quarter's guidance. So to me, this is resulting in the mixed reaction by the market for Cadence that we're seeing today. The growth rates I'm using for Cadence here on the revenue are 12.2% on the bear for the product and maintenance segment, up to 16.2% for the bull, and almost 20% on the bear case for services, up to 22.8% on the bull case. I am forecasting a bit of a slowdown for year one at about 12.2% revenue growth, but all in all, revenue over the next 10 years, I'm expecting to grow about 13% on the bear case, up to 16.9% on the bull case. This is still a very high growth company, and AI will definitely provide another catalyst for growth for Cadence. Their operating margin is 30.9% on a trailing 12 basis. And with Cadence's very wide economic moat and the high switching costs they enjoy, that will give them leverage to raise prices over time faster than what their costs will raise. So that will inevitably expand their margins. So I have the bear case margin at 34%, up to 38% by year 10 for the bull case. This is a business with high operating leverage. Free cash flow margin is at 28.4%. I have that at 31% for the bear case, up to 41% for the bull case. Because they have high operating leverage, that'll translate into higher free cash flow over time. And free cash flow growth itself will be about 12.7% over the next 10 years, to almost 20% for the bull case. So I'm very bullish on Cadence, and I think that they're going to grow even faster than what I'm projecting here. Longtime viewers of my channel know I like to be very conservative in my estimates, because the worst thing you can do is overpay for a business. You want to get it at a reasonable price and then really compound those returns over time. So to that point, is their tiny little slide in the market today enough to justify buying Cadence? Well, let's find out. As of right now, Cadence is trading at $341.23, and their run up in the market this year has skyrocketed their PE ratio, now sitting at 87.9, well above their 5 and 10 year average. Even their forward PE is well above their 5 and 10 year average at 89.1. So while there's a lot of optimism surrounding this business from a growth perspective, given the AI demand, a PE ratio of nearly 90 does seem a bit rich right now for Cadence Design. If we did a reverse DCF based on today's share price, the market is projecting 10-year free cash flow growth of about 17.2%. My base case, as you saw, has their free cash flow growth at about 16.3%. So I'm slightly less optimistic, I suppose, than the market, but I still think that they're going to be a nice free cash flow grower over the next 10 years. My DCF bear price for Cadence is at $239.56, up to a bull price of $419.92. So if they execute beautifully, all this AI demand comes into fruition, and they stay out of hot water with the DOJ and export restriction fines, they can experience some pretty nice share price appreciation here. The exit multiple I have at $337.29. That is based on comps of AppLovin, ServiceNow, Intuit, Autodesk, and Workday. So on that bull case, there is nice upside here of about 14.6%, but without any margin of safety, I do have a buy price at $328.48 and a forward PE of 85.8. So it seems like they're slightly overvalued based on my own valuation summary. But with this business, I want a 20% margin of safety, and part of that's due to we don't know quite yet how this AI demand is going to shake out. It seems like it's all there right now. But as always, we want to wait a few quarters, maybe even a year or two, to really understand how this AI demand is going to play out and if it's going to flow down to businesses like Cadence. So with a 20% margin of safety, that's a buy price of $262.78 and a forward PE of 68.6, which is a little bit above their 5-year average. But for me, at least, Cadence is trading very rich right now. I do think this business does deserve a premium because it's a very solid, high margin business, very capital light. But I certainly would want to see it come down far more in share price than what we saw after today's market drop for me to justify buying it. This is a business I've been watching for a couple years now, and at no point has it ever been attractive enough for me from a price standpoint to buy into it. I would love to, but it's just not there for me yet. Maybe it's a bit like Costco in that it's just going to continue to rise given the fundamentals of the business, but I would like to see it come down quite a bit in share price before adding it to my portfolio. That said, Cadence is a wonderful business. I do expect a lot of growth in the future here. It's certainly going to be driven by AI demand, and this is another cornerstone business in the semiconductor ecosystem. Thank you for watching today's video, and if you've made it this far, go ahead and subscribe to the channel. Thank you, and happy investing.